going to go ahead and welcome you to the work session. We're here with our money manager folks from Alaska Permanent Capital Management. We've got Bill Learman, and Blake Phillips is on the Zoom call. Also, Melanie Imholt, our finance director, is with us tonight. And this is for our annual investment review. At this point, I'll just turn it right over to you, Bill.
I kind of feel a little going back and forth, but it is, as I was mentioning earlier to some, it's been great to actually be in front of you guys. This is the first time I'm actually wearing a tie since pre-COVID. Some of you guys were on the Zoom call last year that I did during the crisis of March, which was a little weird. So I've kind of felt like I've gone full circle with you guys, being a first Zoom call in the middle of the pandemic to now being able to be down with you guys. So I was actually really looking forward to driving down here and actually being with you guys, because I think trying to do it over Zooms, there's some positives, but some disadvantages, as you guys well know. I do have a lot of information. Some of it is the same that you guys saw last year, and I'll go over that. But there is one recommendation that I have presented to the staff to do, just kind of moving some money that requires your guys' attention to move from two buckets to one bucket, and I'll go over that as we go in. But that's probably the one recommendation I'm going to make to the staff and work with staff, moving forward. But I want to kind of get in the details and tell you why I'm making that recommendation. So I kind of want to, have the scope of that, but at any time, if you guys have questions on the markets or whatever, please let me know, and I can stop at any time. About 45 minutes is okay. I'll try to get 30 minutes and then Q&A after that. Does that work? I do have an hour. Okay. Okay. On page one, APCM manages 4 accounts for you guys. Just kind of take a step back. We manage 3 accounts. And then the trust account. And we have a short account, a medium account, long-term account, and trust account. And as we can notice here, the first account, we started our relationship with the City of Sedona in February 2005. And that was the first account. And it had all the money, $18+ million in that one account. And then that got subdivided, and I'll get in more of that in 2015. And then we broke out that one account into 4 accounts. The current market value is that about $500,000 in that short account. My recommendation to you at the end will be move some money from the other accounts into this to replenish that one account. The medium-term account, market value about 8.8, long account 11.5, and then the trust account that pays for the scholarship, things to that nature, about 2.3. So a total that APCM manages about $23.2 million if we add that up across the board. And then if we look at the from inception kind of gross returns, 2.3% annualized rate in the short term, the medium term account 2.07%, the long account 6.42%. You're probably wondering why that returns much higher than the other two. Is that account does have some equity exposure into it, so that has about 45% or 55% equity exposure. So that those returns have generated a little bit more because of the equity exposure. Again, if we look down at the current allocations down, the short account and medium-term account is all fixed income, where that longer-term account has the equity, and same thing with the trust account. So how do we kind of went back, and I think when we look at that return in the equity, and when I was in front of you guys and the markets were falling apart in March, not a very good feelings as an investor. That was very stressful, a lot for everybody involved. But this is a quick snapshot from global markets, and this is an index, the MSCI ACWI index. And basically what this index has is about 2,900 securities, large and mid cap. It's an equity-based, both developed and emerging markets. So it kind of incorporates U.S., the whole world in equity. And it kind of gives us a snapshot what happened. And we can definitely see here in the first quarter, we had the COVID, the U.S. Fed funds rate, which I spoke about, with you guys last time, went to the zero lower bound. They dropped interest rates, tried to promote more market participants. And then all of a sudden in the second quarter, everything rebounded. We almost got everything back in the equity markets. In the second quarter was 19.2, third quarter even more, 8.1, and then here in the fourth quarter, really after the elections, it ramped back up, and there was a return of about 15%. So if someone would have told me that we would have these kind of returns in the equity markets in March, when I spoke to you guys before, I thought you guys would be crazy, but that's exactly what's happened, and there's a couple of reasons why. And before I get into those reasons, I also would like to kind of, when we're thinking about asset returns and we move and we just looked at, what is the equity bent of the world and producing those returns. This is a quick snapshot of what happened in 2020. And when you think of investments and we think of risk-controlled assets, kind of what's in your short account and what's in your medium-term account, those are fixed income. So those are much less volatile than the equity markets, which we will define as risky assets. But we can see throughout 2020, both fixed income and equity were positive returns. And emerging markets and large cap U.S. were the largest contributor to returns across. And then our real assets, commodities, real estate, and infrastructure, much more muted returns. But the thing I think to take out of this is those diamonds, those little diamonds, is kind of our max loss, and that's a period between February 19th, 2020, and through March 20th, on March 23rd. March 23rd was basically the bottom of the markets. That was the most stress in both the fixed income credit markets, but also in the equity. Then the Fed came out with 10 programs, started pumping money and liquidity into the markets, and then we started getting the rebound in both the equity markets and the fixed income markets. And just in general, markets were broken at the time, and those programs really helped just the behavior of the asset classes. So with that, when we kind of move and climbing out of this pandemic, and I think what kind of I've kind of mentioned that central banks eased and really helped, but fiscal policy was tremendous, and we have another fiscal policy that's moving through Congress right now to add another 1.9 trillion into the economy. Those were the two big components that's driving the equity returns and pushing down yields and having positive return in the fixed income. Even with that, inflation expectations were very moderate during that time. And so as inflation expectations were moderate, that allows the Federal Reserve to keep interest rates low in the front end. And most recently, we've had some interest rates move up, but in the front end, they're still very, very low. And because of inflation expectations have been moderate, they're going to be able to do that. The fourth and fifth thing that's kind of going to help the recovery of the economic, with economic growth is, trade tensions has dissipated. Back in fourth quarter of 2019, there was a lot of talk about China and things of that nature, and that was kind of decompressing equity returns. That's kind of gone out of the way. We just heard that the China, parts of the China administration and the Biden administration are going to meet in Anchorage next week. So there's those kind of things that are happening that should continue to help with that. And then in the last, about 70% of the GDP is the consumer, and what are they going to do moving forward? You look at the vaccine data, mobility, if you look at TSA data, all kind of moving up. So there is a lot more hope that people are going to start continuing spending money, the ones that have it, and with the new relief that's coming out, that should continue stirring the economy in a positive manner from the big picture. With that, before I get into the portfolio review, any questions on kind of from a market standpoint, how we kind of got here in the returns in the broad market? And then with that, this is the quarterly packet that you guys receive. I've updated most of this through February 28th. There are some performance numbers that were only through January, and I'll point those out to you. We didn't have the performance numbers because of the meeting so close to the end of February, but I'll point those out to you. But anywhere I could grab the most recent data, we were able to get into this packet. Now, when we look at the upper top right, and here's the accounts, and I've taken the Soldotna Trust, and that's a whole separate entity, and we're just looking at your guys' operating funds here, and this is what you guys have. There's $3.1 million in AMLIP, which is Alaska Municipal League Investment Pool. Think of that as a money market, Vanguard money market or Charles Schwab. You have $918,000 in your checking account. Again, the short term, the medium term, and long term. Now, when we add all those together, we got about $25 million sitting there. So up from where we were at 9/30/2020 at $23 million, now at $25 million. So kind of think about when we're looking at liquidity buckets that the AMLIP and checking are there to pay your bills throughout the year, and then you have your three investment accounts, the short term and the medium term and the long term. If we look at just those three, the three portfolios, the short term, the medium term, and the long term, if we break that out and look at the portfolio exposure, that's and along with the other two, we can kind of see that you guys have about 23% in cash. Your fixed income is about 67%, and then you have your equity and international fixed income right there in the equity. So that's about 22%. Of the piece of the overall, when we look at all five of those counts. On slide 8, I'll start in the, we'll start in the top left. And when we just take the three accounts, the short and the medium and the long term, so the next few pages, I'm going to just speak to those three accounts. And I'm going to kind of drop off the AMLIP and the checking account. The number, when we look at the assets of that, and we look at the total equity exposure out of those three, it's about 32% right now. When we started this back in 2015, that was about 25%. So over time, the long-term account has expanded in market value, and the short-term has been depleted a little bit. And we can see that in the upper right-hand corner. And when we look at the green, that's the long-term account. The magenta color is the medium-term account, and then the blue is the short-term account. And as I mentioned before, when we first started with you guys, all the money was in that short-term account. Securities that are invested anywhere from 0 to out to 3 years. And then we split it up. And then the long term has continued growing because it has the equity exposure. But we've seen that this short-term account has taken over $1 million annually over the last 3 years. So it started with about $3.5 million, and the account's been drawn down a little bit, I believe, because capital improvement projects, Melanie. And so that's now down to about $500,000. And so one of my recommendation to you guys is let's take some money out of the long-term account and the medium-term account and move that back down to the short-term account so we can continue to have that stability moving forward. Yeah.
I think, Melanie, can we just kind of reiterate that point? I think it's an important one, and talk about how, we budget in our operating budget for some revenue to come from our investment earnings. And so if you look at the value of the short, medium, and long together from where they were in February 15 when those three buckets were set up to today, the overall value is higher than it was even with $3 million taken out to be used for operations, capital, et cetera. So Melanie, do you want to just comment a little bit on the taking out of the money from the short-term account and how that fits into our kind of annual budgeting plans?
Yeah, so we've actually earned about $4.5 million on our investments since we began the bucketing. So we've earned about $4.5 million. We've taken out about $3 million. So what Bill's suggesting is moving money from the long and medium term to kind of get back to the closer to the 25% that we were at before, and also giving us some more money available if we need to move it in for operations or capital project expenditures. Just because we're moving, he's recommending $2 million, just because we're moving that $2 million into the short term doesn't necessarily mean we're transferring the money out. It's just available for us to transfer out if we need to. And over the last, like he said, 3 years, we've transferred out about $1 million a year to continue funding operations and capital projects. And we do budget, as part of our operating budget, earnings on these investments. So our intention was always to use the earnings for operations and capital projects.
Okay, just a quick clarification on that. So when we're looking at the amount of revenue that we're generating from our investment accounts annually and factoring that into the city budget, that revenue, I'd assume, is mostly coming from our long-term bucket because that's the only one that actually has equity exposure. So let's say the long-term bucket with that equity exposure makes, I don't know, $500,000 during 1 year. Do we not pull that $500,000 directly out of the long-term bucket? So if the long-term bucket is the one making the money, we're cashing that amount out of the short-term bucket and just leaving the long-term bucket intact to continue growing?
We haven't moved any money since we began this bucketing strategy. So we started with $8 million in long-term, $8 million in medium-term, and the balance of our investments that weren't in AMLIB in cash. That was in the short term, and we've kind of left it as is.
Got it. So whenever we've generated revenue, regardless of which bucket that revenue generates from, we pull it out of the short-term bucket.
We've always pulled it out of the short term. To do anything different, I think, would require a resolution rebucketing.
Got it.
Because when we initially did the resolution, the short term was intended to be operating reserves.
Okay. And was there ever any framework set up when we moved to this model of when we draw, we replenish out of the long term, or is that why we're having that discussion now?
Kind of why we're having that.
Okay,
We have
got
the
it.
discussion every year about, what do we need to do, and I think we've kind of left it in long term because we haven't had the immediate need for it, and it's generating more revenue. But as we deplete the short term, and we have capital projects on the horizon, like our new sports center maintenance project, things like that, we need the money to be able to pay for those things.
Sure.
So we do need to replenish our short-term account.
Got it. And my follow-up question, that last one, is I know the long-term investment bucket will often have strings on the assets that are within it as far as when we can pull that money out, whether that be bonds or real estate investments that might have restrictions on selling. Is that not the case? I would assume.
There's no restrictions on any of those funds.
So in theory, if we wanted to move 100% of the long-term bucket into short-term, we could do that immediately?
Absolutely.
Okay, I was incorrect in my assumption on that then. Thank you.
Give me 2 days' notice to raise all the funds, though.
Well,
But
that's purely hypothetical.
No, very, very, very valid question, Councilman Chilson. All very liquid, all the equities in ETFs, exchange-traded funds and indexes, and the fixed income can be traded and be ready to settle for the next day.
Okay, thank you both.
Absolutely.
Stephanie, if I could, Madam Manager, is it your intent that in the next maybe 1 to 3 years, are we going to most likely, unless there's some unknown, maintain this $1 million a year? Or are you going to have a suggestion of maybe a different amount?
Thank you for the question. So Melanie and I had talked about this, and at $1 million a year, it would be sustainable for the city to continue budgeting both operationally and for capital like we have been. So if we look back at the capital budgets that we've funded over the last several years, if they're in the $750,000 range to maybe $1 million or $1.2 million, that's kind of been our target, I think, every year for capital. We think that this draw, this $1 million per year, would allow us to sustain that into the future. So the only difference would be if the city council wanted to fund, for example, a large capital project, that would necessitate a bigger shift, potentially of reallocating these buckets. But with a $1 million a year draw for us is sustainable to keep doing what we've been doing with I think, a healthy capital budget every year and taking care of operations.
Would it be correct then, from what you said, and everything you said sounds very good, in the next 12 months, would you anticipate a change in terms of a larger amount for a capital project that you would be bringing forward?
No anticipated change from our perspective, I would say, in the next couple of years.
Excellent. Thank you very much. Thank you.
If I might ask a question. So if you're going to take money from the long-term account to the short-term account, is this just an entry on our books so that we leave the money invested the same way it is? So we're not really moving it to an area where it's going to draw less?
Less return,
Yes.
possibly? There is, yes, there would be a potential to have less return if we move some money from the long-term to the short-term account because the asset mix is different. Because the money that we'd be taking out of, I'm proposing $500,000 out of the long-term, so that $500,000 would come out of the long-term, and about 40% of that would be in equity.
So in other words, you would actually cash in those bonds to move it. There's no way to leave it there and make the entry that it belongs to short-term in case we need it, so that it would continue drawing that higher income?
If we're going to move all 500,000 all at once, we would have to sell something to raise that cash, unless we were going to do it in bits and pieces of
I
it.
guess what I'm trying to say is can this just be a paper entry until such time as we need the money?
I believe not.
You can't, huh?
No, I don't believe that.
Thank you.
I think just,
Oh, you can go ahead, Jordan. I have
just to follow up on
lots of questions.
Councilman Hutchings' question, I guess the question would be, what's the point of moving it from the long-term to the short-term bucket if there's no restriction on time? If we can cash out the long-term bucket funds whenever we need them, why would we move it if it's generating higher revenue?
I have a page on that.
Okay.
Can I get to that?
Can I say one thing about that?
Sure, absolutely. This is great.
He's going to talk about the difference between equities and the fixed income and the ratio between the two. But, you know, as far as money available for operations and for capital, one reason to move it ahead of time would be so that we can continue paying for things without having to wait to come back to council to pass a resolution to be able to move the money.
So currently, as it's structured right now, city administration has the authority to draw from short-term without approval of council, and long-term does not, and that's the delineation. Okay.
So we are going to talk about equity versus fixed at some point. Sorry, I was skipping ahead and I didn't see that on there, so,
I
okay.
apologize, Bill. I think I got us off track, but
No,
Bill's
no,
going to come.
this is great. This is great.
One of the questions that I had just off the bat was, I noticed that AMLIP is mentioned on slide 7, but then goes away entirely.
Mm-hmm.
Obviously, is that outside of your purview, I assume? And then, I guess just a question internally then, maybe for Ms. Queen, the amount that goes in there, I guess I just see, you know, a large increase from September to December, and I guess I don't remember what that was intentioned for, or why that happened. And then I see that our market value with major deposits and withdrawals on page 8 just sort of has a general decreasing platform. Not that it isn't healthy, but just a question overall about, I don't know, I feel like as a government body, a responsibility is to see lines going downwards and say, what's going on there? So I guess the question would be, do we have, where do deposits go? I know we have obviously a balance budgetary amount that's higher than what we spend a lot of times in a year. Where does that go? It looks like it goes into the AMLIP account, and why are we not maybe pushing that into some of these other locations? I think that's the crux of my question. Does that make sense?
Melanie's going to answer that question.
So our AMLIP account and our checking account are kind of almost one and the same. So what happens is our sales tax and property tax revenue from the borough gets deposited into our AMLIP account, and then from there, as we need it, we transfer money out into our checking account. So it just depends on the timing of expenditures and the timing of revenues coming in. When you look at the different dates for the balances in AMLIP, it can be affected by quarterly tax returns coming in, so we get those big influxes about 2 months after the end of the quarter. And so it just kind of depends on our timing of when I pull money over to fund whatever expenditures we're paying for at that time, payroll or, projects or whatever we're doing. So that can just kind of go up and down, but that's basically our operating cash for the city is our AMLIP and our checking account. And then about $1 million a year coming out of the short term.
I think I'll just quickly answer the other piece, I think, of your question, which is that when we adopt the budget, the operating budget, at the end of the year, it is true that we might have a small surplus of funds per the operating budget, but what that doesn't account is the mid-year appropriations for capital. So it's true that if we were funding no capital, our fund balance probably would be growing, but it has not been because we use that portion of revenues over expenditures plus additional funds drawn from our short term for our capital budget every year.
Okay, so that just led me, to kind of my final question on that is there a figure that we've set in the AMLIP and checking account as like a ceiling of which if we get over that, there's an amount that then would go into an investment of some sort? And then is there a floor of what we would allow our, portfolio to exist at?
We haven't set a ceiling or a floor. I would not anticipate us ever going over what we would need to keep in there, because I don't anticipate our revenues going up so much and our expenditures going down so much that we would ever reach something higher than we would like to have an AMLIP. I think what could be impacted is maybe needing to draw out $1 million out of our short-term account, if anything. But I think AMLIP and checking are probably where they need to be.
Okay.
But we have never set a ceiling or a floor.
And then last question, I said last questions before, but so if we withdraw $1 million a year, potentially, thus far, we've gained that in order to withdraw from overall. That's what it looks like. I mean, it's obviously colored, so it makes it easy for me, but, okay. Just,
So we've actually earned about $4.5 million off of these investments, and we've taken out $3 million.
perfect, thank you.
Yeah.
Just want to make sure I'm understanding the colors.
Good, I'll go next, if you don't mind. Just another one. If the council decided that they wanted, let's say, lower property taxes, could that be actually, could that happen as a result of spending some of this money that we have? Hypothetically.
Well, I think I'm going to maybe defer back to Bill to talk about maybe the performance, because the decision we will bring back to the council about allocations will impact potential earnings on the bulk, the totality of our investments. And so I think I'll let Bill speak to that question, maybe Mr. Carey, if it's okay, as he describes kind of where we are now versus maybe where he's going to recommend that we consider going.
If I could ask a little differently, which again, I got too specific. In general, is this money that has to stay in here? Cannot go anywhere else except as an investment? Or could it be moved somewhere, including budgets?
Melanie, if I screw this up, please correct me. This is all of the money that the city has is in here already.
Right.
And so it's just whether it's kind of in a short-term bucket that's kind of like an operating fund that the administration can pull from, or whether it's invested in something that potentially is maybe higher risk but higher earning potential. All the funding, all of the city's fund balance is already invested in one of these accounts. It's just a decision about which account and how big each of those buckets does the council want to have to meet our ongoing annual needs for operating and capital.
Let me try it, and I'll probably make it worse. Technically, is this a surplus?
Well, one thing I would like to,
You don't want to answer that one, okay?
One
I
thing I
mean,
would
surplus
like
is a
to-
pretty clear thing.
yeah, well, one thing I would like to clarify is just, I think there's sometimes some confusion between fund balance and then our investments.
Right.
So fund balance is basically, if you were a business, it's retained earnings. It's, your assets less your liabilities
Absolutely.
equals this.
Right.
So our assets aren't all cash. I and aren't all our checking. It's the checking, it's the AMLIP, it's these, plus it's some things that can't be spent, like inventory and things like that.
Sure.
So a lot of times we get confused between what's fund balance and what's cash.
Right.
And so, I'm not quite sure how to answer your question, if this is,
When we initially did 8 million, was that 8 million real dollars that did not, that there was not a requirement to put that into investments? It was logical and it makes a whole lot of sense. But technically, it was more money than what was needed at that time to run that year's government.
yes.
Thank you. And that to me is a surplus, but I'm open, my terminology is wrong. Thank you. And I hope I wasn't unduly aggressive.
No, not at all. No, not at all.
Okay, because I don't ever mean to be offensive. Okay.
I think we're on the same page now. Now, if we can go, because of time, there's one that I definitely want to get to. Kind of follow up with that, if we move to slide 14. In your ordinance, the 3.06.13 is the intent of these accounts. It kind of breaks out the short, medium, and long-term in the trust account and why they're bucketed out the way they are. And you have the AMLIF and the checking account for your, for that year and a little bit more, let's call it 18 months of expenses. Yeah, and then we have the short term, which is, for operating reserves, a little bit longer, and the time horizon in the longer one, where it's intended to hold funds for which the city does not anticipate a current need. And the reason why we're taking equity exposure in there, and we proposed that back in 2015, is to earn that greater return, to have that pricing power. So this is in the ordinance that was set up this way. So kind of give the thought, and why the trust account is separate from the other three accounts, and it should not be commingled with the other three. Let me take a step back, also to kind of look at this, and I'm on page 16, and this is the allocation review summary, and I'll get into how this is going to, why I think this is a good way to move. And this is kind of the timeline with APCM, and starting in May, and the 4 accounts were established with those market accounts. And I just want to kind of step back. The trust was separated because of the ordinance, and so we didn't have to have it commingled. Before that, it was commingled with the city's assets, so that got stripped that away. But the short and the medium-term account was, we created a portfolio. If we look at all three, what's the equity exposure that the council at the time was comfortable with? And we did a whole analysis with you guys on upside, downside, worst case scenario, best case scenario. It's a little outside the scope of what we're doing tonight, but we will get back into that. We showed that again in, I think it was in 2019, that we did the exact same analysis. And when we did the analysis, what we came out of was, if we bucketed it 8 million in the long term, 8 million in the medium term, and that 3.5 million in the short term, it got us roughly about 25% exposure. And with our capital market assumptions, we have a whole team that does 10-year outlooks and things of that nature, upside down. And I showed that. That was about what the council at the time said, I'm comfortable with that risk. It was the first time that the city was taking equity exposure. So it was just taking that first step in, and it was about 25% of the overall bucket. And one of the ways we got there was we looked at the short term, and I worked with staff and said, what are your guys' needs outside your normal operating expenses? And at the time, it was, well, we think we might need $1 million over the next couple of years, and we didn't have anything in the first 2 years, but the last 3 years, we ended up taking that $1 million out, each and every year. So it was a good, and that's how we came up with that $3.5 million, and then we split it up between the medium and long term. So that's kind of, give you guys a background, what was being talked about with APCM and the previous council at that time. And then since then, we've done different things, liquidity reviews, and asset allocation reviews and things of that nature. And we got to remember that, and on the next page, when we're looking at equity exposure, there's this one hand to say, hey, we want to put everything in equity exposure, to get the greatest amount of return that we could out of these assets. Well, that's good. That's going to bring asset growth, there's no question, but it's going to bring a lot of volatility over that time. But we also have this budgetary stability too. And we don't want to get in a situation where we got into March and if we had 100% equity and we had a 40% down, and then all of a sudden you guys came to me and said, Melanie calls me up and goes, hey, we need $2 million for a capital improvement. Bad time to do that. And so when we're looking at that, if we were able to move some, back to kind of to your question, to have this weighing between budget stability and asset growth, between that's what we have to weigh, and we move some of that into that short term. So if we do have some volatility in that long term, we never have to touch that. We can sustain that couple, what we sustained in March. Okay, yeah, we're down for you. It's eventually going to come back, or the world's going to be over. But we're, and I think we're there. But that is also the reason why. Hey, let's put the money in the short term. Melanie brought up one point why that's a good thing, but it also gives some budget stability that we don't. If something does happen in the equity markets in the long term, we don't have to go in and touch that money. And so that's another reason.
So I guess the follow-up question to that would be, I absolutely agree that there would be need to rebalance and pull some funds out of the long-term bucket and replenish that short-term bucket. But I think we could potentially do that without reducing our ratio of equity exposure. So basically, we would increase the percentage of that long-term bucket's equity exposure to compensate for the cash portion that we draw out, so we can still maintain about a 32% equity exposure if we don't choose to increase that potentially. Because I know that when the council originally looked at this, 25% was kind of the comfort level, and we've grown to about 32% due to market performance over the years. I don't have a ton of experience in this, but my immediate inclination would be, why are we not at 40% or something? Because if we're looking at a $23 million cash total, we don't need that anywhere near that level for annual operations. So I guess my additional follow-up to that would be, based on your relationships with other municipalities, what's kind of the common standard out there? I mean, we picked 25 as a council years ago. We're at 32 now. What do you see among other cities? What's kind of the operating norm?
Okay. Great question. I like where you're going with that. There is two ways to add additional equity exposure. There's you can add more money to the long-term bucket, because that's the bucket with the equity exposure. So overall, you're going to have that. And then the second part, I think, is what you're getting at. Within the long term, we don't have to add any more money to that bucket. We can just go from, as it's already 55% equity, 45% fixed. We can increase the equity exposure in just that bucket from 55 to 65%, whatnot.
Sure. Or maybe increase the equity exposure in the midterm bucket. So maybe we do 20% in the midterm and 55 or 60 in the long term.
We could. I would probably recommend just leaving the equity exposure in the long term, because
Sure.
the medium's all fixed, and that's going to be the next bucket to be stripped away.
Okay.
Per se. But with that, when you add equity exposure, we're going to have that more volatility, and there's one other point, that how you guys differ than other municipalities and cities and boroughs, to do an upside downside. And why that's so important is because this is operating funds, technically, and you guys are one of the few people in the United States that do it this way. And it's not a bad thing. It's just that you guys have money. You have leftover money to do this. Most cities don't have money to do this. Or cities have carved out a percentage of this money and put it in a permanent fund. And your colleagues down the road, or Alaska, they carve that out, and so it's not operating money anymore. And it's counted a little bit differently on the budget. So why you don't want to take too much equity exposure, Miss Melanie gives me a call, and we try to budget a number, investment earnings, off this money. And we come, and it's a line item. If you guys are below that, and we have volatility market, let's say in April or May, every June every single security is going to be marked, price to market price, and it rolls through. If there's a big loss, paper loss, markets are down 10%, and we budgeted a positive 2%. Well, you're going to be under budget in that. And I'll let mechanics go through how do you guys solve that. But in your budget, you're gonna show you're well under budget in the investment earnings, where other cities don't have that.
Bill, could I add, the other thing that we talked about on Friday was that this is the first time since 2015 that we're even recommending any reallocation, because up until this point, the buckets have been good exactly as they were. So one of the things we talked about was maybe transferring a small portion to the short-term bucket to make sure that we're okay for the next couple of years, but then inviting Bill back with his team to do a really deep dive on your question, Jordan, about what is the council's risk tolerance now? What are your long-term goals on capital needs? And maybe the long-term bucket really could be treated like a permanent fund where we know we don't need it for X amount of time. That way may lead us to a different investment strategy, but really kind of setting aside a separate time to come back and do that deep dive with the advisors is something that we were kind of thinking would be an appropriate thing at this amount of time has gone since the initial creation.
Okay.
And I'm gonna meet you halfway on the equity exposure in 2 pages.
I keep jumping ahead of you. So.
No, it's all right. So I'm on page 18. So let's look at where we were in May of 2015, and when we initially set this up, and we look at the top portion, and here's the values, and within that long-term bucket, we had 3.4 million in fixed income and 4.5 million in equity exposure that made up that 7.9 million. They're on that right under market value. So the whole portfolio of those three was that 19.4 million. So as we moved to today, we can see the long-term portfolio is 11.5 million. So we've grown, that portfolio has grown from 8 million to 11.5 million. And it makes up about 55% of all the assets that we manage for you guys. The medium term, it's in fixed income, so we, and the performance numbers right around 2% annualized. So we've moved from 8 million to 8.8 million, and that's about 42%. So that's about the same. But then the short term, as we've noted, it is now 3% of the overall funds. Councilmember Jellison, if we look at the equity exposure, we've gone from 4.5 million now up to 6.7 million. So that's the additional the equity exposure. The one thing that, to make note that Melanie had spoken to, we went from 19.4 to almost 21 million. So the whole piece of the 3 accounts has grown to 21 million, so about $1.5 million more, and you guys have taken 3 million out of that. That's that 4.5 million that was talked about at the beginning. So it's doing what it's supposed to do. When we added equity exposure, this is the whole reason. It was because it was established at the time that money was going to be taken out of this, and if we just kept it in short-term fixed income from 1 to 3 years, we weren't going to keep up with the corpus.
So has that growth come exclusively from market returns? I know that it was clarified that when we draw from these buckets, we're only ever drawing from the short-term bucket, but when we have a surplus at the end of the year from our operating revenues, are we only putting that back into the short-term bucket, or are we putting it back across all 3 using the original ratio? Since the council said we want 25% equity, are we putting that a portion of our surplus back into the long term whenever we do contribute back to these?
So if move away from surpluses, let's think about investment gains.
Sure.
Get away from so any investment gains in the long term has always stayed in the long term bucket. It's
Correct.
never been.
I'm talking about when the
with
city has extra, just general cash at the end of the year, and we need to put it back and just invest it. Is that
Oh,
cash that we
from
have?
from AMLA checking account?
Sure, just any extra cash in the checking account at the end of the year. Are we only putting that back in the short-term bucket, or are we actually adding additional cash back into the long-term bucket as we have it available in this?
So it's staying in our AMLIT account and our checking account.
So we have not added $1 to the long-term bucket since we created that fund.
Correct. That's all
Okay.
earnings.
Yes,
Yes,
all
we have
market
put
value, yes.
Nothing back in the investments that Alaska Permanent Capital manages. We've only taken out 3 million.
Got it, okay.
And then if we move to the next page on number 19, where's the, yeah. So we went from that equity exposure of, that 23%. And then now, if we go from that, this February 2021 is exact from the previous page, so nothing different from what's on here on the left-hand side. That's just a quick snapshot from, and then the allocation moving forward. And if we take 500,000 out of the long term, brings it down to 11 million. we take $1.5 million out of the medium term, move it into the short term, and I took a little bit more out of the medium term just because to maintain an equity exposure. That new equity exposure now brings you down to 29%. So we go from 23%, 25%, up to 32%, and now I'm suggesting let's just take a little bit off and move it back down to 29%. My feeling, without doing all the analysis that you guys' risk tolerance a little bit more than what we started with, everybody's a little bit more comfortable with how this is performed, how this is set up from council to council every single year, and we're still generating enough earnings to take care of the 1 million withdrawal that comes out of this. So when we look at the equity exposure, we're going from 6.7 to 6, which is still well above the initial of 4.5. So you guys about have $1.5 million more equity exposure in your account than what you guys had in May of 2015. With that. And I do think that, you know, given time to come back and do the analysis, which would to do the upside, downside, and look, and we can make show you different options of the different equity exposures and things to that nature with downside, upside. But I just want to, you know, make note that you guys are a little bit different than other government entities in how this is set up. Other people do the same thing, short, long, or short, medium, long term, but they don't necessarily have equity exposure in there. With a lot of Alaskan entities that I manage money for, their operating budget, usually all the tax revenue comes in, and it's very seasonal, and it gets drained out throughout the year. Where the permanent funds have the more equity exposure, and they take a portion of their permanent fund and drop it into their budget every single year. There are a few entities that have monies like this, and it's all in treasury bills, treasury notes, agencies, very risk-free assets, because they don't want any, because that's all the things that they have. So if something happened to it, they don't have anything more. They can't go get, there is nothing more. So that's, you know, so I've seen a gamut. I think you guys are somewhere in the middle in regards to that. And when you look at the United States as a whole, Alaskan entities are much better than World 48 because they don't have any rainy day funds, per se.
This is Blake. If I could just add real quick to the conversation. You know, a good way of looking at this whole process too is if you look at that long-term bucket where we have that 55% equity, and I'm just going to be very simplistic with it, but say we have a 10% up market year, and now we're sitting at, you know, over 60% in equities. Now we have the latitude to rebalance that down to target so that it's at 55% equity. And what this process is doing is kind of taking that on a more holistic basis, except for that we don't have the power to move money between the buckets. And that's why we always go through this planning process every year. And so, but it's a very similar process of just expanding it to look at it holistically, but the rebalancing causes a little, you know, more involvement from the council, you know, and as our partners in deciding how we want to set this up. But fortunately, the success of the long-term fund has gotten to the point, you know, where the tail wags the dog a bit. And that's why we have to kind of look at reining that in or doing that deeper dive of, you know, really where we want to be longer term again.
I think, you know, the overall portion of this is just risk management. You know, just understanding that risk that the portfolio is being taken and giving flexibility to move that money from short when the capital project is coming up to be paid. So with that, any more questions?
Question?
Yep,
Since
absolutely.
you mentioned risk management.
Yep.
Obviously, as we look at numbers, there's some groups that are be pretty liberal in terms of expecting good. Others would be very conservative in terms of being, I'm going to say, safe. in a general sense, does your firm expect the next 1 to 2 years in this country and those things that we have invested in? Are we going to do good? Or are we going to be level? Are we going to be losing? And I know that you don't know, and I'm not going to ask you to sign anything, but you do know you have to have a philosophy.
Absolutely.
Okay, and so what is the philosophy, the monetary philosophy that you have for the next couple of years? I looked at your numbers, but those are just numbers. I'm still interested in your expectation.
Let's go to page 21.
I'm there.
You're kind of looking at outlook, and I think the story kind of stays the same, especially in the equity markets over the next couple of years. Is you have very easy monetary policy by the central banks that's going to help out, and you have massive fiscal policy coming down the pipeline to help that equity exposure. So in our view, going forward, we do look at what they call the reflation trade, and we do think the equities will continue to move up. Will there be hiccups along the way? Absolutely. We can't predict them by any stretch of imagination, but we do look at what other central banks and what other countries are doing, and there is a lot of reflationary tailwinds to push the equity markets, continuing.
Okay, thank you.
When I look at your long-term and medium buckets, why do you want to pull money really out of the long-term when it has a better investment return?
The sole reason for that is we could take it out of the medium term and move it down, just use the short term, is that equity exposure going from the original 23-24% to 32% of the overall pie. And if we took a little bit out of the long term, it drops that equity exposure down a little bit. And that's the only reason, to get that, to reduce the volatility. You guys have done so well in that portfolio, just to reduce that volatility of the overall.
So going back to the long-term, what is our, since 2015, have we maintained about a 6% return on that long-term bucket?
Yeah, annualized return, yes.
And the others have been in like 2 to 2?
Yeah, 2.3 in the short term.
Historically?
Yes, correct.
Okay,
Yep.
thank you.
Ms. Parker.
So is it safe to say that you, or we as a council are more comfortable with the risk that we could leave that 500,000 in the long-term bucket and just pull all 2 million from the medium if that was something that we were comfortable with, and that the only reason for pulling that 500 is to reduce the risk and volatility? Is that just? Okay.
That's correct, yes.
Okay.
Yep. And I think the next step into this, and getting feedback from you guys, is to do the whole analysis of the upside and put some numbers in front of you guys. It pays off our projections and the market projections to show what is the upside, what is the downside over a 10-year time frame. But also intraday, we run models, 5,000 paths, that show what's the worst case. Well, I can go back to March and show you the worst case. I think we're gonna, we can probably, we've seen that real time, but we were able to sustain that, and you guys were okay with that. The only one drawback, and I don't necessarily want to pound the table on this, but if that happened in June and not March, and we had that huge comeback, well, that would have flowed through into your financials. You would have showed a loss in your financials. Then it becomes, is it a paper loss? Yes, but that still would have went through. It rebounded so much that it was at 22% in that second quarter that, oh, okay, well, everything's back to normal type standpoint. So we just have to be aware of those. What's the risk factor on the other side? If we do have a downside, when is that downside? That's why I always like downsides in January, because I have 11 more months to make it look at it, and everybody looks at their monthly statements at December, right? They look at the December statement. So that's I just want to be cognizant of that, because we are dealing with, basically the city of Soda, the savings account, per se. But this is much better than Zoom, by the way.
Yes, agreed 1,000,000%. On slide 22, just a couple of questions on what some of these statements mean. In the heading at the top where it says short-term yields should move in the next 24 months, Can you describe what that is?
Yeah,
talking
so in
about?
Fed funds rate, which is the interest rate that they control, they can move it up and down, which is what credit is based off of. So that is really associated to AMLIP rates and what you're going to get in your checking accounts. When we look, and these are some graphs that I believe that within 2 years, the Fed funds rates, they will have to push the Fed funds rate up. So where in the last, and if we look at in this top left-hand graph, and thank you for asking this question because I get excited about these type of things. When we look at the last cycle, in beginning of December 2008, that's when the last time the Federal Reserve dropped it to 0%, right after the global financial crisis. It took them 84 months before they raised rates. I'm saying this time that we're going to be more if we look at the months on that axis, that we're going to be about in about 40th month before they start raising rates. Now the market's already pricing in a rate in first quarter of 2023 is what the market's pricing into the market currently, which is much different than where it was 6 months ago when they're going to stay lower bound 0 all the way through 2023. How that impacts your portfolios as interest rates rise, bond prices go down, so you'll have some negative return from the price action, and in the medium term and some bonds in your longer term, you'll have that as interest rates rise, negative prices will come into some of those accounts. And the reinvestment earnings in AMLIP and their checking account, which is very minimal right now, as they raise the Fed funds rate, then the earnings will be greater in those two accounts.
That's sort of what I thought you were meaning on that. So, meaning although currently some of the investment in our longer term buckets is performing well, there is a potential based off of historical figures that moving some funds into a shorter term area of our financials has the potential to yield a greater return over the course of the next year to 2 years. Is that am I understanding that correctly?
We would be giving up some returns, moving some funds from the long and medium term into the short term. We're gaining the flexibility and dampening the volatility of their overall portfolio.
But they wouldn't perform poorly in the short term.
No, they would. I would not suspect that you would have negative returns, annual returns in that shorter account.
Okay.
You'd be better than the checking account, but you're not going to be as well in the long term, as I previously, kind of hinted at. That I believe the equity market's moving up, but we don't know when that downside is going to be during that cycle.
Yeah, and that leads me to the last page, I guess, page 24, where it says that you remain cautious on credit and prefer investment in firms with positive free cash flow and sufficient liquidity. Can you just describe that briefly for me, that sentence?
Yeah, absolutely. So when we're in the fixed income world, when we look at bonds that we buy for that, if it's Darden Investments or any corporates that issue bonds, and we buy a lot of corporate bonds, we're very cautious when we look at those, because we do believe that there is some downgrade possibilities because of the leverage. The leverage in the system of corporates has moved up since the financial crisis from about 3.5 times leverage up to about 4.5, 5 times if you look at the index. And so when we're looking at this, and you guys do have some corporate bond exposure, that we are cautious in that space, in the investment grade space. Do we think they're going to go bankrupt? No, not at all. But they are price perfected. I mean, the spreads that you're going to gain to buy, the incremental income you're going to buy in a corporate bond over a treasury is very, very at historical lows. So it's price perfected. And when we're when we're buying individual credit names, we're trying, when we do our due diligence in our team at APCM, we're trying to buy investment grade bonds that have positive free cash flow on their balance sheet, and we can look back during the March first quarter, second, which ones maintain, and also have a good debt profile, so they don't have to roll over their debt anytime soon. So those are two matrix that we're using when we're buying individual credit names.
Okay, thank you.
Ms. Queen.
Thank you. So we're really nearing the end of our time. I want to make sure we have an ability to talk about what happens next steps. So I want to pose a question about, both to Bill and Melanie, about timing. What would be the timing, Melanie, from your perspective, that we need additional funds available in the short-term account, knowing that that's a council resolution that would potentially transfer those funds? And then kind of associated with that, Bill, what would be a reasonable time frame if the council wanted to have that deep dive sooner rather than later? Kind of when could we come back and do that deep dive? Is it necessary that we have a resolution transferring some funds prior to that, or can you both speak to kind of the timeframes for those two potential actions?
So typically, the $1 million that we've been drawing out each year has been during the summertime when a lot of the capital projects are going. So I would anticipate needing money, probably some additional money then, if we need to pull some out this year. But that could also be impacted by when some of our other projects get going that may not necessarily be summer dependent, like the sports center. I'm not sure the status of that capital project and when the expenditures would be, when we need to pay for those. That could impact when we need the money. But we don't need it tomorrow or anything, but I would anticipate probably the summertime, possibly sooner. Yeah, well, May, maybe, starting maybe in May, sometime starting probably in May, but that could change based on, when, I don't know the status of that project, so if that kicks off, it could be sooner than that, I don't know.
To do all the analysis, if we can have like at least a month to put all the numbers together and put the presentation together and things of that nature.
So we, at least when we spoke on Friday, our thought was potentially coming with a recommendation to transfer this funding, and then next year doing the deep dive. It may be possible that we can actually plan to do that deep dive early May even, and then allow the council to advise on any potential transfers after you've had the ability to have that additional analysis presented.
Yeah, I'm more than happy to go back and talk with Brandy and her team that do most of the analysis on that, and try to find a date that, and get that in the hopper. I know they're working on a few projects, and we can move yours, up, and I just want to go back.
I think we'll, if the council and Mr. Mayor, if you're supportive, what we'll do is just get back together to see if that's feasible, assess our comfort level with, as Melanie said, where the capital projects are in their different phases, and just report back to you based on the input we heard tonight.
Brief question, if I may, Mr. Mayor?
Go ahead.
So this budget cycle coming up, is this the conversion this year to the biannual budget that we're going to be working through?
Correct. The budget that we're building right now is a biennial budget, so for FY22 and FY23.
Okay. Yeah, it would certainly be my hope that we could have a lot of that conversation around that whole, talk about money in May, seems right. Yeah? No? Melanie, money, May. It's alliterated. Okay.
I would echo that. I don't know where the rest of the council is, but my thought is we should probably go forward with resolution now, implementing recommended changes from staff, move some cash from the long-term bucket to the short-term bucket to meet the foreseeable needs, which leaves us at approximately close to where we were on the current equity exposure. We'd be going from 32% equity exposure to about 29, 30, somewhere in there. And then sometime in the next month or two, get together and discuss whether or not we want to increase that exposure. And there's nothing stopping us from transferring additional funding into an equity-based fund. So that's where I am.
So we really need 2 million transferred, is that what you're saying?
No, I don't think, I think, Melanie, we've got 558,000 in the short term as of February 28th. Melanie may foresee an anticipated draw potentially of $1 million within the next 6 months or 4 months. The original thought to transfer $2 million would have provided us a couple years worth of draw. So we would have the ability to transfer less than that, sooner than that, but I wouldn't want to maybe comment on that until we had a chance to talk through that with Bill. It's not something we discussed prior to the meeting.
Okay, because I'm really thinking that what we need to be looking at is maybe the $1.5 million out of the short, the medium, and not do anything with the long term. I think if we're not needing that money right now, that we should leave it where it is to draw, because we're going to be 18 to 24 months, you said before interest rates were going to be going up and therefore dropping our investment income. I would say that we leave what's in long-term there and just take out of short-term, since that's the lowest return historically.
Mr. Carey?
Just to add to this, it goes around, I very much like the recommendation that's here. To me, I'd rather do the 2 million, get it done with. We can look down the road in other ways. But I want to be sure you have no questions in terms of whether or not you've got funds for what we need. This is an extremely healthy thing the city has. And you may all know that already, but I just want to, I go back to 2005 when we started talking to you, when I was here. This is really nice, and we should do everything we can to make sure that it makes things work for you. And when it works for you, those people who get goods from us, our contractors, different things, it makes it better for them. And so from my standpoint, I very much like exactly what's here, the $500,000 and then the $1.5 million put in, so for what it's worth.
Any other comments?
I'd just like to say thank you, Bill. This has been very, very informative, and I appreciate your patience in humoring me on all the questions. So.
No, this has been fantastic. I appreciate just being able to be in front of you guys. I mean, unlike Zooms and things of that nature. But anytime we get the back and forth and it's beneficial for you guys, I can come in here and just spit off page after page. And I mean, I get excited about it. But if it helps you guys make your guys' decisions and we can have that working dialogue back and forth, and that's the relationship it has to be, right? And I'll work with staff and try to put a date together to get you guys those numbers and what it will look like. It was the plus side, downside, but also what different equity exposures would look like. So, right now we're at the 30, 32, maybe what a 40 or something, and really understand what that volatility looks like, and to try to grasp that number in your head, that downside, upside, if that downside did happen in an April or May or whatnot. So if that's
Yes. Thank you.
work for you, Mayor.
Yes. Anything works for me right now.
I know. You only got, 3 more hours?
Yeah, as long as the weather holds up, or doesn't get any worse, I should say. I'll either be in Mexico or